Welcome everybody. Hopefully you can see me on the screen. I'll just double check audience view to make sure I'm coming through okay. And we've done the sound check balance before the webcast started. I'll just do one last sound check and double checking all the audio here. It looks like I'm coming through loud and clear. So let me know, how am I coming? Am I still coming through okay? Yes, a few of you are still noting coming through. Okay, touch wood. We're all okay technically. My name's Russell Markham. I'm the Director of Education for VectorVest Asia Pacific, and it's my pleasure to be able to present tonight. Thank you to the Australian Shareholders Association for allowing me to present tonight. And I've just got a list here so I don't forget everybody, so excuse me for looking down, but I just want to thank Brian McCarthy, Graham Hawkins from the chapter there in Geelong. I was to have gone along just the other night. In fact, it would have been tonight to have presented, but of course with restrictions taking place with travel and whatever have you at the moment, it was not possible. And that then born about the idea about doing a webcast. And then at that stage there we thought, well, why not? If we do it for Geelong, why not open it up to everybody else? So thank you for that great idea there. John Cowling, thank you for allowing me the opportunity. Yazzie and Christine from the Australian Shareholders Association, who work tirelessly behind the scenes. They've made this all possible, so thank you very much for all the hard work you've done in promoting this opportunity to present the education here and for allowing me to be here. Okay, without further ado, let's jump in tonight. So into the presentation. So that's me. I'm live in Queensland, and hey, we're in the same time now as New South Wales. We've caught up. Okay, so I'll move myself to there for now. And just a disclaimer here from the Australian Shareholders Association. So the Australian Shareholders Association has provided the facilities for the meeting. In this particular case here, it's a webcast for tonight, and it provides general information about the ASA and to stimulate interest in financial markets. The ASA is not licensed to give financial advice. The content of this presentation is not designed to provide any specific investment advice to any person present. The ASA does not accept any responsibility to inform you of any matter that subsequently comes to our notice that may affect any of the information discussed, and anyone wishing to act on any matter discussed should seek independent advice from a licensed advisor. All right, ditto with VectorVest. Okay, I won't read that verbatim, but effectively everything that we discussed tonight, if you're interested in finding out more, please do speak to your licensed professional. So I'll just put myself back on the screen here just to let you know I'm not licensed to give advice. All right, so I'm no longer a financial planner. I was a financial planner many moons ago, but I'm no longer licensed to give advice. I now represent VectorVest, and everything that we disclose tonight is for education purposes only. Okay, so let's jump into the next slide here. I just want to point out, put your questions to me. You know, don't hold back, and chances are I'll be able to answer them on the spot. I've got the tools in front of me tonight to investigate further on a certain question, so I can certainly dig into it. The aim tonight here is not to flog VectorVest to you. Okay, I represent VectorVest. I love VectorVest. I use the tools. I eat, live, and breathe the product. So that's what I use to analyze. But of course, if you've got your products, you've got your software, you've got your other tools that you use, then great. All the more power to you. It's all about empowering you tonight. I want to share with you key information. Chances are there'll be some great information that you'll walk away with tonight to say, oh yeah, great. I really enjoyed that bit of information. I'll investigate it further. Okay, so that's what it's all about tonight, sharing and empowering. So finding the right stocks for your SMSF account, that's what it's all about tonight. So we want to know what a share is really worth. We want to know how safe it is, and we want to know when to buy, sell, or hold. Ultimately, if you can answer those questions there, you're on the track to making good money within your self-managed super fund. Are you buying excessively overpriced shares? Do you know the safety track record of those shares? Plenty of investors invest into shares and then get the fright of their life when they actually realize that they've bought into a company that's heavily indebted as not going too well. The other mistake a lot of investors make, of course, is buying in at the wrong time. If you bought in over the last 5-6 weeks, you're probably regretting the fact that you bought in just before the market had quite a severe pullback because of the coronavirus. So if we can time the market, if we can find those good quality stocks, and we can make sure that we're not paying over the top for those stocks, we're well on our way to making money. So we want to minimize risk by finding sustainable dividend paying stocks year in and year out. Now let me show you some empirical research, right? So I'm going to bring in some third-party research here. If you hop onto Google and you just simply type in why dividends matter plus, more timer or page, you can't miss it. It'll pop up there for you. In the chat box here, I'm actually going to paste that link there for you as well. Okay, so I believe I've put that link in there. Let me just do this. I've got the report. So let me just jump into the report. Here's the report. I'll copy this link. All right, so there it is. It's a bit difficult to see, but I'm going to put it into the chat box and I'm going to send it to everybody. It's free. It's publicly available information out there on the internet. Anyhow, cut a long story short, this report, as you scroll through it, it's about page 2 or 3. You'll see there's a very interesting table. Now, this report was done for the United States, so it isn't necessarily 100% applicable to Australia, but it's most likely going to be very, very close. So let me jump to the slides instead. All right, so I'll jump to the slides here. What I've done is I've taken the graph there on, I think it's page 3 of the report, and just blown it up so it looks a little bit easier to see on your screen tonight. But what I want to show you here is empirically over 30, 40 plus years, in fact it's over 40 years worth of data, the authors behind this report, so if you hop in over here, Dr. Ian Mortimer and Matthew Page, they've both got master's degrees in physics, right? So mathematicians, very smart individuals. They found their way into the investing world, very quantitative based. Cut a long story short, this is what their research shows. If you compare it to the S&P 500 index over a long time period, right, so over 40 plus years, the index over the last 40 odd years has done just over 7% on average. Some years have been great, some years haven't, on average around about the 7% mark. But you'll see over here companies that are growing their dividends. So dividend growers and initiators, they initiate more and more dividends. If they're not paying, they're initiated to pay, they then pay, and then they grow their dividends. They have outperformed the index. Conversely, on the flip side here, non-dividend paying stocks have not outperformed. Now, if you think about it, it makes sense, right? Is a company more or less likely to pay dividends if it's doing well? If a company's making more and more money year in and year out, chances are it's going to be in a better position to meet or exceed any dividend obligations. And once it obligates itself to dividends, it's likely to meet or exceed going into the future, provided that it's making more and more money year in and year out. Typically, that's what you'd expect, right? So it's no surprises to see that the companies initiating and growing their dividends are top of the pop, so to speak. It's no surprises to see that companies that are not paying dividends or cutting their dividends or eliminating them are at the bottom of the heap, so to speak. These are all dividend paying stocks, so you can benchmark it against the initiators. And this is dividend pays with no change in dividends. So again, if you think about it, why would a company not continue to increase its dividends? And one of the reasons behind that is because if companies are not feeling particularly confident with how they're performing, or maybe the board is just very tight with money, again, which leads to the question, why are they being tight with the money? Well, it tells you something. So we want to be here. Why not get into companies that are growing their dividends year in and year out? Because there's a twofold win here, right? A, you're going to get the dividends, likely to get the dividends, more likely. And secondly, you're more likely to outperform the index on average, the general market as it performs. Okay, so I just wanted to share that with you, and let's now relate it back to Australia. So what if I said to you, for our self-managed super funds, what we want to do? What we want to do is we want to find top dividend paying stocks. And great, thank you folks. Keep the questions coming in. I promise I will answer all of them as the presentation goes on, so don't hold back. If you want to put a question, put them through to me. Thanks, Don, for your question. I'll get onto that shortly. Okay, so finding dividends greater than 3%. What if we can identify those stocks in Australia? Okay, so just to set the scene, and big pardon for those that, of course, already know this. We already know it, but let's just set the scene here. Dividend distribution of a company's Earnings to shareholders, there's the important word, earnings. Dividend yield, the amount a company pays out relative to its share price. Right, so the amount paid out relative to its share price. Dividend yield is the dividends paid divided by the share price. All right, and then if you want to represent it as a percentage, which we do, we then multiply through by 100. Okay, so just setting the scene there. That's what we're talking about. So high dividend yield. List of all the stocks with a dividend yield of 3% or better. And let's have a look where the price is $2 or better, and then let's sort them with some of the best fundamentals and technicals that money can find. All right, so there are companies that pay out good dividends, but some of them might be penny stocks. And as a general rule of thumb, I'm being very conservative. I'm not going to be looking at the penny stocks tonight. I'm going to be very conservative. All right, so at least $2 or better. How many stocks meet that criteria? Right, at the moment here, I can see, if I jump to the next slide here, 97. All right, so I've got VectorVest to do the work. You don't need VectorVest to do that, of course. You can use other tools out there, but just there, I can see currently there are 97 that currently meet that criteria. This company will come up again later tonight in the presentation. There's Fortescue Metal. It's a good reason why it's right up there. I'll cover that later on. Okay, but 97. So straight away, if you go back to the more timer and page research, there is the starting of this that we're starting to look for. So we've identified $2 or better stocks with 3% or better yield. Doesn't mean we're necessarily going to find the stocks that outperform, but we've started to narrow it down. We've still got about 96 odd stocks to narrow down further. Okay, but we've narrowed down just over 2,000 stocks in Australia down to 97. Okay, so we're going to do a little bit more work. Okay, so I'll move to the next slide here. And as I go on to note in the slide, which shares are the best? Not all dividend payers are the same. Which dividend payers are the most reliable? Which dividend payers are looking to grow their dividends year in and year out to tie back with that empirical research? And which dividend payers have their earnings to back their dividends? So in other words, they've got enough money behind them to meet or exceed their dividend obligations. When you're buying into a company for your self-managed super fund, you're buying into, for dividends that is, when you're buying into a company for dividends, you're effectively are buying in on the reliability of a company's profitability. Typically, not always, but typically, good profitable companies are going to be in a position to meet or exceed dividends. Now we've seen over the years, for example, someone like Telstra, they effectively pay out just about everything that they make from an earnings perspective. And then there might be some years where it's caught a little bit short and companies have to go out there and raise further capital by borrowing money or effectively issuing more shares. Not good for you as a shareholder. So you want to make sure that you've got a company that can more than exceed its dividend obligations if need be. So in other words, you want to make sure it's got plenty of petrol in the tank to go the distance. So let's set the scene. Okay, so again, depending on who you want to use for your analysis, you might use a third party, maybe you do it yourself via the Australian Stock Exchange, but I'll just show you just a general methodology to find those top quality stocks for your self-managed super funds. So here's a list, and what I've done here is I've said, okay, let's find the dividend yield of 3% or better. Let's limit it to the ASX 100. Okay, so ASX 100, why is that? Well, a lot of investors out there say, I'm only interested in the big blue chip type stocks. I don't want to see any penny types of stocks. I don't really want to see any mid-cap type stocks. Just give me the big household names. So in this particular example, I'm going to deal with the top 100 by market capitalization. So that's effectively the current share price multiplied by the number of shares outstanding. That gives you what we call market capitalization. In other words, it's just a fancy word for saying how big are those companies. So these are the biggest companies money can buy effectively. Okay, so you'll see quite a few here that we've all know Fortescue, Rio, Magellan, BHP. I mean, these are big household names. Okay, so we start off, we look at the price, we look at the dividend, and then remember it's the dividend divided by the share price times 100 to give you the yield. So you can then run your eye down and start looking at the yield component. So you've got some pretty attractive yields there. And one of the reasons why the yields are so high at the moment is because a lot of share prices have come down. With the coronavirus, there's been a big sell down in the market. A lot of these companies, time will tell whether they do cut their dividends, but a lot of companies won't cut their dividends. So if you've bought in at a lower share price and you're likely to still get the same dividend whether or not the company had gone up or down in price, and you bought in at a cheap price, you're in for the running for a good yield potentially. Okay. What I'll do here is I'll just change the pointer here. I'm just going to make it visible at all times. So arrow options here visible so it doesn't hide. Okay. So we set the scene. So I run my eye down here and I go, oh, nearly 9% with Fortescue. Really? Do you think they're going to pay me 9% based on the current share price? And I run down a bit further, 7, some very, very good dividends. Okay. Well, the next question then is, well, how safe are those dividends? I've been caught out. I caught the bug to investing when I was 19. I'm now in my mid-40s. And I remember in my early 30s, I was buying a lot of high dividend paying stocks because I thought this was a great way to bring in some extra money. Only to find out the hard way that, well, hang on, this company that said it was going to pay about 4.5% dividends, I just knew it was too good to be true. I didn't get the 4%. I got about 3.6. Yeah, I'm not complaining. It's still really good. But had I known it was going to be 3.6 versus 4.5, I might have thought a little bit differently about the stock at the time. Okay, so what we do here at VectorVest, and of course you can do this yourself by checking the track record for what a company has done. So what we're doing here is we're looking at what a company said it would do versus what it did. So a high dividend safety score, and you can do that by checking the track record of given companies on the ASX. If a company's met or exceeded its dividends over the last couple of years, chances are you're going to give it a good pass grade. Now at VectorVest we call this dividend safety, and we rank it on a scale of 0 to 99, kind of like a report card. So when you're at school, if you got a 50%, your parents might have sort of said to you, you need to study a bit harder for that exam. But for VectorVest, a 50 or better for dividend safety is actually a very good score. In Australia, if you can find dividends of 60 or better out of 99, you're finding some of the best that money can buy. Okay, so 50 or better is good, 60 or better is excellent. So you can see over here, look at that, Coles Group. Everyone's rushing out to stock up on supplies, concerned about the coronavirus. It's no surprises to see the financials at the moment starting to move up on some of these retailers. And as a result here, Coles Group has got a safety score currently of 58. Now that's not just because of the current environment, it's also because of what's happened in going back. Now this is a recent sort of spin-off. I know there's been different derivations there, but if you run your eye down here too, 54 for Evolution, 52, very good scores, nothing wrong with that. Rio, 52. I'm not saying there's anything wrong with Magellan or BHP, but relative to the other ones here in the database, these have proven to be a slightly stronger set of parameters in recent times. Okay, so over here I've just highlighted the ones that sort of, here the ones that sort of jump out, 50 or better scores. Here is a really important indicator. Now again, you can get this from third-party research, wherever it is that you choose, but I want to show you something very interesting. I didn't learn this until I was probably in my late 30s, and kind of kicked myself for not having known about this a lot earlier in my life. This would have saved me a lot of pain. An earnings yield here is effectively what a company can afford to pay, and you can then compare that to what a dividend yield is doing. Here's the important takeaway. If the earnings yield is less than the dividend yield, then you've got to ask yourself the question, where is the money going to come from? Where is the company going to get the money from? Are they going to borrow? Are they going to issue more shares? Are they going to cut their dividends? Or in worst case scenario, they just don't pay their dividends. Okay, so look here for Fortescue, 9.71. Great, a lot of money in terms of up their sleeve. 9.71 yield up their sleeve. And this one here, APA, 2.71. Now let's have a look. Fortescue, 9.71, looking to pay out 8.91. They've got enough. All right. So when I look at this and I say, ooh, do you think they're really going to pay out close to 9% based on current share price? Well, the earnings yield is telling me that this company's got a very good chance of doing that. They've got enough in the tank. Safety track record is 50 or better, which again gives me confidence. If I have a look at this one here, APA Group, 2.71, looking to pay out 5.21. Right, there's likely to be potentially a little bit of a shortfall. So if you go to the annual general meeting, you might want to say, look, just want to confirm there might be some shortfall per my analysis. Can I please check with the board where potentially any of that shortfall is going to be made up, or is there the possibility that the dividends will be cut to reflect that? Okay, so it gives you the power and empowers you to be aware of it. Now, as an investor, if I'm after dividends and I'm really chasing after dividends, I would prefer my earnings yield to more than exceed the dividend yield. And Fortescue 9.71, 8.91, a little bit of wiggle room, not too much. But look at this one here, Rio, 12.64, paying out 7.27. Okay, so if you go to the annual general meeting there, you're armed with that knowledge. You could effectively ask one of the Rio Tinto executives to say, well, technically you've got enough to pay 12% dividends. You're paying out 7, thanks. It's really good, but hey, you know, is there a possibility we could get 8 or 9? They might tell you, look, mate, you're doing pretty well at 7%. All right, but it just gives you confidence, right? Gives you confidence. Okay, so I'll move on here. Just a few that jumped out at me where I compared the yields to the dividends. So it's just interesting to run that analysis. All right, let's take a few steps back. So that was interesting from a self-managed super fund perspective, finding some great dividend-paying stocks. Okay, why don't we do this? Let's do this. Why don't we, and I'll just expand out the Q&A box. Thanks, keep them coming. Some good questions coming through. Why don't we consider this? Let's say we're going to go and find dividends of 3% or better. So you could do that on the ASX. You could run your eye down and find all the dividend yields of 3% or better. And let's limit it to the 100 and 200, ASX 100 and 200 only. Fair few stocks there. And let's make sure that our safety is 55. I'm going to be a little bit more fussy here. 55. I know 60 is excellent, but in current market conditions, a few companies are under a bit of pressure. So I'll put it at 55, which is still very, very good. I want my interim and my final franking credits to be fully franked. So make sure that when you pay the dividends that they are fully franked so I can get those tax benefits. Make sure that the company is also looking to grow its dividends by 10% or better. So again, you can go to third-party sources and find that all out. At VectorVest, this is what we do. We call it dividend growth. So we're making sure that the company is on track to grow its dividends by 10% or better. It's a very difficult task to do in the current environment. A lot of companies are worried about their profits. There's earning downgrades potentially for many of these companies on the way. So it's a tough time to be talking about growing dividends, right? But nonetheless, I thought let's put it out there and see what comes back. It's interesting, a lot of the mining companies are coming back strong at the moment in terms of what they are looking to do from a dividend perspective, right? So I then have a look, I run that, and it brings me back some key stocks. So again, it empowers the investor. You need to empower yourself. However you do that through your research, you want to make sure, based on more time and pages research, you've got good dividends, consistent dividends. You want to make sure the company's got enough money behind it to meet or exceed those dividends. And you also want to make sure that the company's looking to grow its dividends. No point buying into a company that has got, let's say, 4 or 5% dividend yield on offer, only to find out, sorry, we're looking to cut the dividends this year. Okay, so here are the ones that jump out. It's interesting to see just how many mining companies are popping up. Okay, so I can run my eye down here, see, okay, the dividends, the safety track record, look at that. Mineral Resources here, 60, very strong track record, 3.54, looking to grow its dividends by 14%. More than enough petrol in the tank to go the distance, so to speak, 13.31, looking to pay out 3.54. That gives me confidence, and as an investor, I want to make sure the company's got enough. I want to make sure the company's got a good track record of meeting or exceeding, and I want to make sure that the company's looking to grow its dividends. And as an added extra, why not? Let's take the franking credits on offer. Nobody ever complains with extra money in their back pocket. Okay, so these are some of the techniques that I use to empower me to get better shares for my self-managed super fund. It gives me full control. Okay, so next slide here. I'll just show you how some of these stocks look from a graphical perspective. Okay, so this graph over here, that's the share price. Another technique that I look at is I look at the earnings, the 12-month leading forecast on earnings. If you're buying into companies that are decreasing their earnings, so the earnings are under heavy pressure, they're falling away. What do you think that's going to do to dividends? What do you think that's going to do to the share price? Yeah, you got it right. Typically, falling earnings will impact upon dividends at some point. You only need to look at BHP over the years. Remember when BHP started to fall away on the share price, the earnings were falling away. And then in recent times, the earnings started to turn around and we started to see the share price powering up. Let me just do this if I haven't already got this already. I'll bring the BHP share price over just to show you. So just in here, let's bring it up, BHP.AX. Whoops, no, this is the US, sorry. It's not the one I want to bring up, it's the US. We're not going to find, there's BHP listed, but it won't be .AX. Bear with me. Let's go to graphs. Here we go. BHP.AX. So here's a really important correlation here. I'll just fire this up and I'll bring this back just a little bit in time. Okay, so this is the earnings. It'll just take a few seconds just to fire up. My internet's a wee bit slow tonight because I'm presenting a course that chews up a wee bit of bandwidth, so we'll just have to give it a few seconds. But you're going to see a strong correlation between the share price and earnings, and you'll also see a strong correlation between the dividends that take place. Okay, so I'll just give us a few seconds. Sorry, it's just all the bandwidth has been effectively dedicated to the presentation. I think I've actually got a slide set on here that I can show you shortly as well. Okay, but there you're seeing the strong correlation, earnings, share price. The other thing I'm wanting to look at too here is I'm wanting to see dividend yield and I'm wanting to see dividends. Can you see the correlation here between the earnings going up and dividends going up? Here's the yield. So strong earnings, strong dividends, consistent yield taking place. That's what I'm looking for. Okay, next one here, Fortescue Metals. So we saw this one popping up before. We're having a look at it again. Fortescue Metals. Here we're seeing earnings, look at that, really starting to turn around quite rapidly here. Look at the dividends being paid. As a company makes more and more money based on the dividends taking place, the earnings should I say, we see that flowing through on the dividends. That's really encouraging to see when we see that taking place. All right, here's Rio. Okay, so with Rio you can see the same sort of deal taking place here. You can see dividends starting to fire up in combination with earnings taking place. Okay, so just double checking my internet here just to make sure I can get some speed allocated to running the software for us. But look, I've got everything on slide sets tonight anyhow, so it's all good. So let's keep going. Good correlation there on Rio. I've done it a bit on BHP. I did want to pull it back a little bit further for you tonight, but can you see the correlation here? Earnings falling, right? Dividends falling. Earnings turning around, dividends turning around. Okay, so I'll just bring this up, see if I can get just a few more years on that. I'll bring it across shortly. Okay, Fisher & Paykel. This has been an interesting stock. Its earnings kind of sat flat for a wee while. So it was kind of sort of, hovering along quite flat for quite some time. And then all of a sudden, whoosh, up go the earnings. And look what happens at the same time here too. Dividends start taking off. When you start to see a strong uplift in the dividends being paid by a company, even though you might not get any confirmation via the earnings, you can almost bet your bottom dollar there's going to be some positive earnings announcements. Not always, but typically. Why would a company be willing to pay out more in dividends? So for a lot of our younger investors, for example, when I go on the road and I meet a lot of investors, a lot of our younger investors say to me, Russell, how do I find explosive growth type stocks? And I say to the younger investors out there, I say, buy companies with solid rising dividends. And they look at me and they go, no, I think you confused me here. I'm not after dividends, I'm after solid growth. I said, yes, buy those rising dividend paying stocks, because companies that can sustain upward moving dividends are companies with solid earnings typically, and companies with solid earnings are companies with
rapidly moving upward share prices. Okay, so it's all connected, if you know what I mean. So you can get the best of both worlds. All right, so here we go. I've managed to allocate some bandwidth here. And yeah, so you can see that correlation there, the earnings falling, share price falling. If we put on the actual dividends in dollars and cents, so I'll just change the style on this. I'll just make it jump out just a wee bit better with a different color for us. Just bring that up just to show you there. And of course, you can do this on many different bits of software out there like Yahoo Finance, but you'll see that correlation where you're seeing earnings falling away and then eventually the share price goes. So credit to BHP, it swam against the tide for quite some time, but eventually it caught up. There, the earnings start turning around and up go those dividends. And I've seen it time and time again. If you want another good example, have a look at Telstra. Bring up Telstra, you see a very similar correlation. Okay, next one here. So a lot of you have asked tonight, you've texted me in, beg your pardon, not texted, emailed, should I say, emailed me in, and you said, Russell, can you also cover the banks tonight? Can you have a bit of a look in regards to the banks? So per popular request, absolutely, let's have a look. Now, again, I'm going to say here, don't shoot the messenger, all right? I'm just going to show you the mathematics. I'm not going to take a side on this. I'm just going to purely read it as I see it using the math. It's often upsetting if you own a large swathe of a certain company and when you see someone coming on saying, well, the earnings are falling, but be it as it may, take a step back and just look at what's in front of you. With the banks, you're not going to like a lot of what I'm going to have to say here. ANZ, I've seen the earnings falling for quite some time. All right, doesn't surprise me at all to see the share price continuing to be under pressure. Earnings have been under a lot of pressure for quite some time. As a result of the falling share price, this is the yield. The yield is starting to pick up. Makes sense, right? As the share price drops, the dividends are sort of holding steady. So as a result, the dividend divided by a diminishing share price is going to lead naturally to a higher yield. Don't be caught out. It's tempting to say, oh, with ANZ I can get this whopping dividend. It looks like about 10% potentially on the cards. But ask yourself this question. If earnings continue to decline, at what point are those dividends going to get cut? Okay, and we've seen it time and time again over the years. As the earnings fall more and more under pressure, the dividends get cut. Go and have a look at Telstra. Go and have a look at BHP. I think Westpac Bank did it just the other day. Let's have a look. Here's Commonwealth Bank. Commonwealth Bank has been steady on dividends, very, very steady. You've got to hand it to Commonwealth Bank, just steady. Very consistent, very reliable on the dividends, so a good, safe track record on the dividends. But again, the earnings are declining. At what point do the dividends come under pressure? I can't tell you that, but I do know that historically, that the more earnings continue to fall, the more pressure a company will be placed under to alleviate its obligations on dividends. I'm not saying it will, but if we continue to see the earnings falling, it does start increasing the probabilities of a cut potentially. Okay, NAB. So here's another interesting one. Look at NAB. So NAB's earnings been falling, and there we go. It has now cut its dividends in recent times. Okay, so that's dividends paid out in dollars and cents. The yield's gone up because, of course, the share price has come off quite a bit. Okay. Westpac Bank. So we saw this just the other day. The announcement came out. Profit was down. All that took place, and the dividends were cut as a result. And we could see that a mile out because we see that the earnings have been falling for quite some time. So whoever you use, make sure that you're looking at a forecasted earnings going out, not only what's taking place now. So look at historic, look at current, and then also make sure you're looking at forecasted earnings, because forecasted earnings are just as important as historical earnings. Okay, Macquarie Bank. Now, Macquarie Bank, I have to give it to Macquarie Bank. They've got the best set of earnings in the top 5 banks. No doubt about it. The earnings have been great. Why then such a big sell down? I think there's been some concern about how much leverage is on Macquarie's books. Who knows? During the GFC, a lot of people remember that Macquarie Bank was under a lot of pressure because of quite a bit of leverage on their books. So All of that sort of might be playing in the back of people's minds. But if I take a step back and I look at it, the earnings still look pretty solid to me. It has come under pressure. If you zoom in a bit here, you'll see in recent times it has come off a bit, but it certainly had one of the better set of earnings profiles from an earnings perspective. And as the earnings powered on, so did the dividends, and the yield has held pretty steady up until recently when the prices come down to push the yield up. Here's Telstra. Okay, so a lot of you held Telstra over the years. Let's bring up Telstra, and here you can see the earnings falling away. Now it's interesting because I presented at a lot of the Australian Shareholders Association chapters, and this was a hotly debated topic in regards to Telstra. A lot of investors felt that at that point here, as we started to see the turnaround, that it would be potentially a great time to pick up Telstra because it was so cheap. I stood my ground and said, well, perhaps maybe from a short-term perspective, a technical perspective, you can pick the upswing, but I just don't like what I'm seeing on the earnings profiles. I'm not convinced. The bleed has stopped, so it's no longer dropping in earnings, so it's kind of leveled off. But in order for the share price to go up, you do really need to see the engine room starting to fire back up again, which I just wasn't seeing, and I'm still not seeing it yet. Okay, from a dividend perspective, see the correlation there. Earnings fall and eventually down go the dividends. All right, so for a lot of investors that buy, hold and hope type strategy, bought Telstra back in the day, hanging on to Telstra, have no intention of ever selling it, want to keep it forever. But the question I'd have to ask is why? Why hang on to a company where the earnings continue to decline? Well, I'm hanging on to it because I'm getting great dividends. Okay, but a falling set of earnings is ultimately going to impact not only the share price, but the dividends at some point. Now, if I had said that as I did back here in 2015, 2016 and 2017, I've got egg all over my face. Investors would be saying, Russell, you said that falling earnings could impact on dividends. Well, that hasn't happened with Telstra. Well, eventually it did. Okay, so it did take a bit longer than I thought. I thought it was going to happen around about here as we started to see the decline, but it took a year or two later. But we just want to be careful as investors. Why hang on to a company that's under financial pressure on earnings? Why not get into a company that is growing its earnings? So I'm seeing a few questions coming in saying, great, you're showing us all the ones where the earnings are falling. What about showing us some good ones where the earnings are going up? Okay, so I put together just a basic watch list, and I'll share with you the stocks behind this. What if you could build yourself a portfolio that had an earnings profile like this? This was done as of the 6th of April, just the other day. And that is the earnings profile. So it was under pressure in 2015, 2016, and then from mid-2016 onwards, off it went. What stocks did that entail? Okay, and let's see here. So I've done that one twice. All right, so here we are. Now, please, again, I'm not licensed to give advice. All right. Just purely jot those codes down and see what you think. Run them through the analysis that you apply, but there are the facts. That is those stocks. That is the earnings profile. Now, this profile here that we provide at VectorVest, it looks at historic, current, and it also has forecast built into it. Okay, so that's one that I did just for a bit of fun leading up to the presentation here. I wanted to pick some big company type names. So I didn't want to do it on any penny stocks. So you can see over here I've picked some pretty big blue chip type stocks. Okay, so when putting your portfolios together, make sure you've got the earnings behind it, because you've got good earnings, there's your dividends. There they go again. And I've seen that correlation time and time again, not just in Australia. I've seen it in UK, I've seen it in Europe, I've seen it in Canada, I've seen it in Hong Kong, I've seen it in Singapore, I've seen it in the United States. It's history repeating over and over again. There's no rocket science behind it. A lot of investors, when they get this concept, they say, really, is that all there is to it? No, surely it must be more complicated than that. Think about it. Why do company share prices go up? Because companies are making more money. They're more profitable. Why do share prices fall? Because they release bad earnings reports, losing money. That's why they fall, typically. Okay, there's some other factors, of course, but that's what it kind of comes down to in essence. Okay, so I'll jump out of here. Just something for a little bit of fun here. 4 steady dividend pays. So if you were going to build something that pays you a good dividend and has good quality stocks behind it, this is kind of what you want to do. You want to make sure you've got this correlation here, the rising earnings, your rising dividends, and your earnings yield holding steady. Now you can see here's the impact of the coronavirus. So it did undo a lot of the good work on the 4 steady dividend payers that we put together. I'm not saying you need to get access to these stocks. It's just an example just to show you some of the stuff that we do that you would do as an investor if you're wanting to buy good quality dividend paying type stocks. There it is. There's that correlation yet again, okay, taking place. No doubt when the market turns and things start to improve, if the earnings do hold up, time will tell. It looks like they have a little bit of a dip at the moment, but if the earnings continue to hold up and start powering up again, no doubt you'll see that recover pretty quickly. And I've seen that time and time again. You only need to go back to the global financial crisis and pick some of the best earning profiles that money can buy and watch what happens when the market turns with those top earning profile companies. Okay, just some additional techniques. I'm just filtering through the slides here. So here's some additional techniques I want to show you. So what about a net profit margin? So this is something that I put together this afternoon. I wasn't going to present it because I thought maybe I'm sort of getting a little bit technical, but I've worked out a way to show you this in a simple way where it's really fun to do without getting into too much accounting or finance. So what is net profit margin? So this is my definition. It's not going to be as fancy as the financial professionals out there. I just want a nice simple definition. Believe it or not, I actually like simplicity, all right? You know, at the end of the day, I always say to people, just show me how to make money. That's all I want to know. I don't need to go through all the whiz and bang and technical type stuff. Just show me how to make money. So net profit margin, how much money does a company make in the dollar after expenses are accounted for? Okay, that's copyrighted. I made that up. No, I'm just joking. But I did. I made it up, right? But in simple terms, how much are you making? For every dollar that you spend, what do you make? So here I just did a little bit of a simple exercise. Don't get bogged down by all the technical mathematics in here. I'm not after all that. Really, to cut a long story short, I'm just wanting to find companies where I've got a good net profit margin. So I've said, find me a company with a net profit margin over the last 52 weeks, the last year, they've increased their net profit margin by 10%. So in other words, they're making 10% more profit than what they did a year ago. It's pretty good, right? Who wouldn't want an extra 10% profit? Who wouldn't want an extra 10% pay in their back pocket? Now, net profit margin on its own can be misleading. So if you're looking to buy companies out there for your self-managed super fund, net profit margin on its own can be misleading because effectively, yes, you might have a good margin, but if you're not selling much, well, you're not really earning much. So you might have an excellent net profit margin, but your sales are declining. So the net effect is, although you're making more money for every dollar you invest, you're not selling as much as what you were, say, a year ago, so it nets out and you might end up being worse off as a result. So to counter for that, I said, well, find me companies where there's a strong net profit margin taking place. Find me companies where the sales have increased by at least 10%. So I'm making 10% more profit and I'm selling 10% more on average. So it's a win-win. I'm growing my sales and I'm making more money on each sale that I make. Okay, so I put in a couple of extra parameters. Let's not worry about those for now. I've limited this to ASX 200 and I've said, give me sales of at least $100 million a year or better. There's that company again, Fortescue Metal. It's popping up. So Fortescue Metal is making a net profit margin of around about 18% at the moment. So for every $100 that Fortescue Metal invests into the business, right, so every $100 they're making about $18 in profit. That's after all the costs, wages, depreciation. It's a theoretical expense, but all the expenses that take place, that's what they're making on average, right? So roughly that's what it is. Now, over the last 52 weeks, net profit margin for Fortescue Metals has increased by 50%. That's thanks in part due to the rising commodity prices, but as we've seen, oil and the likes have come off. But we have seen that over the last 12 months. We've seen some good uplift in commodity prices, no thanks to the last couple of weeks, but on average over last year. And over here, look at this. Sales have increased by 95% over the last 12 months. So ask yourself this question. If you're looking to buy a company for your self-managed super fund, why not buy a company that's making more money, so net profit margin, and doing more sales? Why not? Well, a few of you might say, well, yeah, that's great, so it's doing well, but it's not paying enough in the dividend. Well, in this particular case it is, but you then need to weigh up, okay, are you after just capital growth, or do you need capital growth and yield, or are you just after yield? If you're after just yield dividends, make sure, of course, that you are looking for parameters that sustain capital growth, because if a company is not profitable, it's unlikely in the long run to keep the yield up, as we saw earlier. Look at that, CSL. So there it is. Net profit 36%, 52 weeks, it's grown its net profit by 53% over the last 52 weeks. It's pretty impressive. And the sales are up 10%. Who wouldn't want to consider a company like that? Now, you've got to be careful, of course. It doesn't mean that you're just going to rush out now and buy those stocks, because you've got to make sure that the market conditions are right. All right, we don't know what's going to happen in the market. The market could leg another 10 or 20% to the downside. We don't know. So you've got to, of course, time that market. Go in when things are better. You wouldn't want to be going in on the eye of a storm, because yes, you might be buying top fundamental and technical companies, but what's the point of picking those up if the market legs down again? You've got good assets that are likely to fall as that market falls. Okay, so I just want to graph them for you. Here's a bit of fun. Fortescue Metals, so you can see there's the earnings, all important earnings, and look at that, no surprises. Companies growing their earnings are companies where you can see the net profit margins holding pretty well here. There's the 18%. This is down a little bit from a while back, but over a year it's up. But look at that, the sales are up. So the sales are more than making up for the dip in some of the net profit margin. So you're growing your sales and you're making 18% for every dollar, or 18 cents for every dollar, or $18 for every 100 invested into that business. That's what you like to see as a self-managed super fund investor. Here's CSL. So you see how it stacks up. Look at the earnings. No surprises there. The earnings are going well. There's your net profit margin. And here are your sales going up nicely too. I really like the look of this one here. The net profit's holding very strong there at 36 odd percent. And look at the sales. Up they go. So these are working in tandem at the moment. There's no surprises to see CSL doing well. All right. I thought I'd throw in some of the retailers, because a few of you have asked me during the week too if I could cover some of the retailers. So here it is for a bit of fun. Notice this on the retailers. Retailers typically don't make high net profit margin. So you can see here, Woolworths, 2.94. You might be forgiven for thinking, ooh, I'm a bit concerned about that in my self-managed super fund account. But look more carefully at the sales. These are in millions. 61,807,000 million. Right, so I need a few extra zeros in my calculator to calculate that. So they're super high volume, super low margin. If you're getting around about 3% on 61,800 million, that's a lot of money. Okay, so I wanted to throw that in there. Same with JB Hi-Fi. You can see, look how the sales are growing. They've gone from, 4,000 million up to 7,000 million, I think it is. So it's nearly doubled its sales. Although the net profit margins come down, it's still 4% on a huge amount of sales taking place. All right, here's the banks. A few of you asked on the banks again. So here's another way to look at it. I thought I'd just bring up CBA. So you see your earnings falling. Here is your net profit margin. The banks are still very profitable, 21% net profit margin. There's a lot of companies out there that would love to be in the 20s for net profit margin. Okay, but relative to where they were before, the net profit margin has come off quite a bit. However, sales have picked up a bit to offset some of that decline, but not nearly enough to offset the decline in the net profit margin. That's why you're seeing a bit of pressure there on the banks. Okay, just an extra aside in there. A few people said to me, it'd be interesting to see how would that pan out if you took the principles of a net profit margin and were to have bought high net profit margin type stocks over the years. How would that have worked? So in VectorVest, I've done a back test just for a bit of fun on high net profit margin stocks, and they're not too bad. 21%. It's annualized, excluding dividends and or franking credits. So and draw down there on the portfolio, the most it ever lost on a peak to trough cycle. Pretty impressive considering the coronavirus. So if anyone ever wants to know the settings on that, email me through. Drop me an email, and I'm happy to give you the settings behind that, education purposes only. Okay. A few of you asked me on gold stocks earlier in the week as well. How is gold stacked up? So I got to work, and I did some back testing on top quality gold stocks. These are gold stocks growing their earnings. Now here's something interesting with the gold stocks in Australia. A lot of the gold stocks are not good quality stocks. They're not in production. They're not producing gold. They're still in the feasibility study stage. They're still in the debt financing stage, seeking debt finance. Good luck in the current environment. Very, very difficult to get debt financing. So you want to look at the gold companies that are actually producing, the physical gold at the moment, because nothing beats being able to do that in the current environment, right? So you want companies that are producing the gold and then selling onto the spot market at the higher prices without too many hedges behind them. Okay, so they're realizing the good value in terms of the gold prices, but not all those companies are doing it. So I only picked on gold companies that were producing and that were growing their earnings. And you can see that on average, not too bad there. It's done just shy of just under 8% over a long period. You can see in recent times it has moved up, but interestingly, it's interesting to see that gold had a bit of a surge, and then on average, I've noticed some of the top quality gold stocks have come off a bit. And that's typical of a difficult market. Like we saw that during the global financial crisis. The global financial crisis didn't spare many stocks at all, including gold stocks. It looks like coronavirus is doing a fairly similar number here on the gold stocks. Okay, so even the safe haven gold has been under some pressure too. It'll be interesting to see what happens going forward. All right, so this is just a portfolio that I put together just the other day, safe and sure portfolio. The reason I brought this up is just to say, when you're looking to invest for your self-managed super fund, make sure you test your strategies before you're committing real capital. So if I look at something like this and say, yep, on average, that looks pretty good. Even with coronavirus here, I can see it hasn't had too much dramatic drawdown. So that's another tip I want to share with you tonight. Test your strategies. Don't go in blind. Okay, a lot of investors go in blind. They go, well, I'm going to do this, and that, and it looks good on paper. And then in reality, they commit their hard-earned money and learn some very expensive mistakes. From some very expensive mistakes. Test it, because chances are, when I first started investing and before I started getting into back testing, I then started to back test my ideas, and I went, ooh, thank goodness I tested that before I put my hard-earned money. And here's a little secret: the more time you're prepared into back testing your strategies and perfecting them, the luckier you get on the results. All right, I'm just joking there, because there's no luck involved. After a while, once you've done enough homework, you've put in the hard work, on average, you're going to get those returns. If you go in unprepared, chances are you're going to learn some expensive lessons. Okay, so I'll jump through here. Here's another one I put together for a bit of fun as well. Okay, the last part of the presentation, and then I'll get into all the questions, and that is just questions come in. Yes, it is being recorded. Yes, folks, I'm recording it, so don't worry, it's being recorded. And I'll get that to the team there at the Australian Shareholders Association, so they'll get it out to you, and I'm most happy for you to pass it on as well. I'm not copywriting any of this. Okay, the last part of the presentation I wanted to share here with you is I promised I would give you some techniques behind protecting your portfolio. Okay, so with coronavirus and fear about the pandemic and meltdown of world markets and all that sort of stuff, I've kind of limited myself to not watching too much of the news each night, because it's just so depressing listening to all the stuff. But I do need to be informed, but at the same time too, I don't want to sort of feel sort of helpless and hopeless. there's a lot of noise out there at the moment, and it's easy to get caught up in the doom and gloom. But believe you me, where there's adversity, there is opportunity, and it's always the case. Adversity brings about opportunity. We have got some great quality blue chip stocks right now in Australia that have been way oversold. Okay, it's just based on the pure mathematics. They've been way oversold. When the market does start turning around, you watch some of those top quality blue chip stocks will come back pretty quickly. Okay, so how can we avoid, some of the concerns out there at the moment? It goes without saying, the first one here, diversify. So, you don't want to put your money all into one industry or sector. So if you're holding all of your stocks, let's say in the airline industry, well, your portfolio would look abysmal at the moment. But if you had diversified across mining, manufacturing, retail, and several other industries, you would be much better off on average. Okay, dollar weight, just the general theory behind this. I often come across investors that say, look, I'm diversified. I've got 5 or 6 different industries, and my portfolio is diversified. And you look a bit close and you go, well, hang on, you've got 85% of your total net worth in BHP. That's not diversified. You haven't dollar weighted. So what I mean by that is if you've got $100,000 to invest and you want to buy 10 positions, then on average you start off putting about 10,000 into each position. You don't put, sort of $85,000 into BHP and then distribute the remaining 15,000 across 9 positions. Okay, so dollar weight. Goes without saying, keep the brokerage low. I think it's not a problem these days because there's a lot of good quality brokerages offering low commissions. Don't buck the trend. This is a really important one here. If the market's falling, don't try to be a hero and stand in front of the market. Don't try to stand in front of the bull. You're going to get bulldozed over. So what I mean by that is at the moment the market is headed down or starting to turn. We're just starting to see the first signs of the turning. We don't know just yet. It might leg down yet. But, 2 or 3 weeks ago, if I said to you, hey, who's game to jump into the market? Well, you'd be surprised. There's a lot of investors out there that did. Oh, well, my gut kind of tells me now's the right time to go. I think I should jump in now. I read just the other day, I think it was a newspaper clipping. It was interesting. There were 1 or 2 investors, I won't name names, well-known people, big industry celebrities, and they had bought in about 2 or 3 weeks ago, said that they were now going into the market. Okay, well, what do they know that we don't know? But certainly what I can see at the moment in the market, why not wait until the coast is clear? Sure, you might forego some profit, but then you don't run the risk of taking another 10, 20% hit. Okay, so step in carefully. So what we say by that is don't jump all in at once. So as you start to see the market turn, you need 10 positions. You might pick up 1 or 2 positions, wait a week or 3 to see if everything's okay. And if it's okay, then you keep stepping in until eventually you build up all of your positions. You're not just going to all jump in and go, you know what, it's all too hard. I'll just drop a whole lot of money right in right now and hope for the best. What we want to do is we want to step in carefully, such that if the market does leg back down again, we've only got 20-30% of our capital deployed. If you take a 10% haircut on 30% of your capital deployed, it's much less than taking a 10% haircut on 100% deployed. Okay, the 50% rule, I wish I'd used this one earlier in my life. Never give back more than half your profit. Now, this one here, you've got to set a profit objective. I'm not saying if you're up 5%, then set your stop loss so you don't lose more than 2.5%. It'll be very difficult to do. But set a profit target. I typically around about the 10 to 15% mark. If I'm up 10 or 15%, and then I want to put a stop loss in where I'll walk away with at least half of my profit. How many of you have been in a share where you're up $20, $30, $40,000? I've met plenty of people where that's the case. And then you give it all back to the market and take a loss on top. And that really hurts, especially when you go down to the car dealership and work out what $60,000 would have bought you for a new car. The 1% rule. This is a really interesting one. And often you probably won't hear this too often, but it's well worth talking about here. What you want to do here is you never want to risk more than 1 to 2% of your portfolio value on any single position. So let me give you an example. Let's say you've got $100,000. Okay, so I'll just use a round number, 100,000. And you're going to put equal amounts into each position. So you're going to put 10,000 a pop times 10 takes you to $100,000. So the question I then got to ask you is, what stop loss are you going to use? What stop loss are you going to use whereby you're not going to risk more than 1 to 2% of your total investable capital? I'm not talking about your total net worth. I'm talking about your total investable capital. All right, well, if you think about it, you've got a 10,000 into each position. So 10,000 times 10% is equal to $1,000, right? 10% of 10,000 is 1,000. 1,000 of your $100,000 that you invest is 1%. So if you were going to buy 10 stocks and put 10,000 across each stock for your $100,000, then you could effectively look at a 10% stop loss, because a 10% stop loss on a $10,000 position is $1,000 that you would lose, and $1,000 of $100,000 is no more than 1% of your investable capital. Okay, or you could put that to 20%, which would then be $2,000 per position, no more than 2% of your total investable capital. If you are nervous when you wake up in the morning, you're investing in the market, not in current market, because I think a lot of people are naturally concerned right now, but in normal sort of more normal, I guess, trading conditions, if you're waking up and your hands get a bit tingly as you log into your broker platform and you feel the hairs at the back of your neck starting to stand up and you start to sort of to perspire, your hands start tingling and sweating, well, you know what? Chances are you're risking too much capital. You're risking too much capital. If you know that you're not going to lose more than 1 to 2% of your total investable capital per position, and a position goes against you, it's not the end of the world. You go, oh, well, yeah, I'm a bit annoyed by that. But anyway, you know what? It's 1% of my total investable capital. I live to fight another day. As opposed to somebody that goes, oh, I've just lost 40% of my investable capital because I put all my money into one share and it didn't work out. A lot more difficult to recover from that. Okay. So the last part here I've got, but it's just time permitting. How are you guys going for time? I'm on the hour, so I'm happy now to call it quits. But if you want, I can do one last exercise, which I often do at the chapters. It's a bit of fun. What I do is I get you guys to throw a few stocks at me. So in the Q&A box, you can push a few stocks through to me. We build a watch list. We have a look at the watch list, and then we draw some conclusions and leave it at that. So what I'll do before I do that, if there is time, what I'll do here is I'll just run through the questions put through me. Okay, so I'll try my best to get through them. If it's very specific on VectorVest, I'm not going to talk about very specific VectorVest stuff because it's not fair for those that have attended. I don't want to make this VectorVest centric. Okay, so I'll keep it general. So let's see here. Pascal asks, is the market likely to fall again soon, or will it continue to improve slowly? Here's the good news. We are seeing two key market timing indicators that we track at VectorVest. We're starting to see some signs of life. However, I cannot predict the market. I can only read what's in front of me. We're just starting to see the early onsets of it turning. But if I go back to the global financial crisis, we saw the same thing play out. We saw the early turn, and then it waved back down about 7-8% before it then finally got going in March of 2009, and we had an explosive bull rally. So my gut tells me potentially it might be another little wave down before we start to see a good rally. Okay, I can't predict, but I'm seeing the initial onsets of a technical turnaround currently. Okay, sorry, I can't answer it much more than that, but I can't tell you with absolute certainty, but we're starting to see some good signs of life. Let's see, I won't answer anything that's super specific on VectorVest. So Pascal, in regards to the 20-minute delay, we're certainly working on that in regards to the real-time data. Okay, Don asks, why is the government recommending banks cease paying dividends? Notes Don, well, perhaps for some of those companies out there, I guess it would be in the government's best interest that the companies don't pay out too much in dividends, because if they're on the hook per their promises to shareholders and they pay out, maybe it puts them into some financial strife, which in turn then means that the government has to bail some of those companies out. I don't know. Maybe that might be the reason. I guess the government's also concerned. They don't know what the full extent is going to be on some of the companies. So I guess they're saying to the companies, just go carefully with your finances at the moment. Trim back where you can, within reason. Don't put yourself into a position of too much debt where we effectively have to bail you out. I'm just guessing. That might be, if I was treasurer, I would probably be wanting to be sending that message out, because I certainly wouldn't want to knock at my door saying, oh, hang on, we need $6 billion, please, for a bailout. And I'll say, well, didn't you just pay out $1 billion in dividends? Okay. Dennis asks, some stocks, the price is under the valuation, however, recommendation is to sell. Please explain risk rate leisure price of 21.75, VV value of 31.21, but it says sell. Okay, so just to break it down into simple terms, what we do at VectorVest every day is we value up companies. So it's based on things like earnings, earnings growth rates, forecasted future cash flows, all those key ingredients go in. There's nothing wrong in owning a company that is overvalued. There's all sorts of reasons why people pay premiums. The banks have had a good premium for many years because of the dividends, right? Aristocrats had some good premiums on there, not because of the dividends per se, but it's more the fact that there's anticipated expectations on this. You know, the earnings are powering on and things are doing really well. So people come in, they're prepared to pay a bit of a premium. If you're buying into companies where you have paid a fair bit of premium, you certainly want to make sure that you've got your risk and money management rules in place. Because as we've seen, what's been very interesting with the analysis in recent months, I've seen plenty of companies where the price has gone back down to meet the valuation. So for example, if I bring up ANZ, sorry, it's probably going to be my bandwidth's pretty slow again, but on here, if I put in the value, you see here, we've been giving ANZ a value. Let's take away this all for now. We've been giving it a value here of around about $17, $18 for quite some time. All right, I'll just zoom it in just to slow down the data sensing. But it's come back down, and now it's been a little bit oversold in my humble opinion. All right, so it's interesting that price at some point will converge back down to valuation. Now back here, a lot of people would have probably said, there's no way. How come you've got a valuation of $18 odd when the price is up at 28? But it's interesting, when the tide turns, a lot of companies will typically come back down to their valuations. Okay, let's see, next one here. Victoria asks, could you please talk about today's conditions and your views on market timing? Okay, I'm just mindful of those that are not VectorVest users. I don't want to abuse my privilege here, but just to put it into just a quick context here, if I hop to the home page here, we've got our first green light popping up. So for our VectorVest subscribers, that means it's the RT kicker timing signals just giving us the first hint of this market turning around. It's been a long, long time since we've got the last green. Okay, so Victoria, I'll just leave it at that. Check out the GLB RT kicker. We've just got our first signs of life. All right, so that's why I'm a little bit excited tonight, because we're just starting to see that turnaround. Okay, Mark notes some of the companies like Webjet probably will not pay dividends due to COVID-19. Absolutely. I mean, someone like Webjet's in a fair bit of difficulty at the moment, a tough business to be in. You've effectively had your business taken away from you until such time that there's some form of normality coming back, and very tough times for them. And you know, when you're under that circumstance, why would you be wanting to pay out dividends? Okay, so yeah, it's a good point there. Thanks for that, Mark. Let's see, next question coming in. ASX 200 are at most risk of dividends, e.g. lower or stopped. What ASX are most risk in terms of their dividends? Well, I can do that quickly for you just for a bit of fun here. Let's do this. Let's go to ASX watch list, S&P ASX. I'll go to the 200 and I'll just fire this up. Sorry, it's a little bit slow tonight. I've been having a bit of a slower internet business connection in recent days. Okay, so companies where they're under a bit of pressure at the moment, if I do this, if I click on dividend safety, so I'm going to click on companies that have got some of the best dividend safety out of the ASX 200, and I'll show all the stocks. So I'll show all 200. And I'll go down to the worst rated ones. I won't go to the zero ratings, because the zero means it's not paying dividends. So it's not fair to say, well, that's a bad dividend payer, because it just doesn't pay the dividend, right? So there's only a handful out of the ASX that don't pay dividends. So these are the ones here, or at least the dividend is so unreliable that it's been given a zero score. But some of the lowest ones here, right, these are the ones popping up where you can see they've got very low dividend safety scores. So this health company here, EHE, for example, is looking to reduce its dividends by 13%. It's currently paying 10%. Let's see, it's got a safety of 25. And let's see, where's that earnings yield? This is a slightly different layout here. I'll just see if I can find it. So the earnings yield's 8.4. So this company's got an 8.4 and it's looking to pay out a 10%. So that doesn't help the dividend safety at the moment. And the other thing it impacts, so if you're wanting to find, let me do this, I'll graph the stock. If you're wanting to find why a company is under dividend pressure, and again, no matter who you use, you might use it, Yahoo Finance or whatever you use, one of the reasons why a company is under dividend difficulty is because the earnings are under pressure. So we saw this one here, it's got a very low dividend safety score. And when you pull it back over here, it's no wonder that dividends are under pressure, because earnings are under pressure. And you'll see a strong correlation. Falling earnings, falling dividend safety scores. Makes sense. Rising earnings, better dividend safety scores. So this company here is under a little bit of financial pressure at the moment, and it's impacting on dividends. Okay, so I hope that helps. Let's jump out of here. Okay. Victoria notes, I don't think any EPS are relevant right now. The companies have no idea how they're going to fare. And it's a good point. A lot of companies out there don't know what the earnings are going to be. Here's something that I like to keep my eye on. And you can hop on to Google. There's plenty of providers out there that will give you earnings calendars. So I'll just demonstrate it in here, but you can hop on, and Bloomberg does a good job of it. I've seen it on Bloomberg. I think Yahoo Finance does it as well, does a great job. So what you can do is you can go in and have a look at upcoming dividend or earning announcements. So here I'll just click on Events Viewer. So you'll see them coming up on the ASX as well. You'll see companies where they'll tell you, this is when we're going to be releasing our earnings. So I don't know if anyone's been following ERA today. Did they release an earnings announcement? They were due to release one today. And what did they say? Interesting, very interesting, right? If you're concerned, so you're worried, you don't know what the earning announcement's going to be, companies are hinting at the fact that they don't really know. Some companies are refusing to do them altogether, but where one is coming out, what you could do is you could say, okay, let's scroll down a bit till we find one coming up. So here's Rio and Woodside, due at this stage on the 16th. Now, if you're concerned about what Rio might say or what Woodside might say, you can always sell those shares before the announcements come out, right? I'm not going to take the risk. I'll just move to the side. Let's see what the announcements are. If the announcements are good, then I can always buy back in. You don't want to be caught out where you're holding a share and the announcement comes out and it's awful. A terrible announcement. Sorry, profits are going to be down 40%. Our current earnings are down 20%, and we don't really know what the future holds, and the board is concerned about the outlook at present. You could only imagine what that's going to do to the share price when the when the halt is lifted. It's going to drop like a hot potato out of the sky, right? Why take that risk? So you might say, well, hang on, this is where the earnings are coming up. So you can hop into, say, Bloomberg, and they do an earnings calendar. You can look for your companies and be aware such that they're on your radar. Am I prepared to hold on in the current environment with the earnings announcement coming due? Or is it just not worth the risk, right? So you can empower yourself that way. So good question there, Victoria. It's a very good point in the current market. Okay, next one here. Graham notes, hi, I'm brand new to this. I have enlisted a financial advisor from a large stockbroking company. How do I know that the advice is pure to me and not skewed to the company whose advice I'm depending on? Okay, I've got to be careful what I say here. Don't want to get myself into trouble. But look, you want to make sure that they fully, and they have to by law now, fully disclose where the commissions are coming from. when I was a financial advisor, and I don't know what the rules are now, but when I presented a solution, I had to have 2 or 3 to compare against. I say, well, this is one offering from this company, this is another offering from that company, and this is a third offering. And therefore, the end user could be well informed. They could say, okay, well, you know, why is it the one that you're recommending is paying the highest commission? Is it because you're feathering your own nest, or is it because it's really good for me at the end of the day? And if you're overly concerned, say to your advisor, say, I don't want 3 different comparisons, I want 10 different comparisons. And if your advisor says, sorry, I can't do that, then say, well, thanks, but no thanks. I'll shop elsewhere. So I guess what you want is someone that's fully independent. You don't want somebody that's associated with just selling their company's products. All right, I won't say too much more on that. You just want to make sure that you've got some choice being provided to you, and you're not just being given, you know, the Henry model Ford type sort of offering. What I mean by that is, remember, what was it, Henry Ford? He said you can have any color car as long as it's black in color, right? You can have any car as long as it's black. Well, you know, you're forcing me to have only one color, but hey, I'm giving you the choice. As long as it's black, you can have it, right? So you don't want that with your advisor. You want to make sure your advisor gives you, you know, 5 to 10 different colors to choose from, so to speak. Okay. And Graham, research it as well. There's plenty of good resources there on the web where you can actually see the ratings on advisors. So have a look on there, Google it up, you know, I think like Rate My Advisor, or I can't remember, there was a website out there where it actually lists any misdemeanors against advisors, so you as the public can be informed. So you Google up your advisor, and, you know, and are there any black marks against his or her name? Have there been any pending court cases or any pending disputes? So you go in fully informed. Okay, so thanks for that. Hannah asks, they produce massive volume of PPE. All right, so there was that CSL? I can't remember. It was one of the companies we're looking at. Sorry if I missed what that related to. If anyone knows that there, let us know. But yeah, thanks for sharing that with us. Sorry, I missed it when it popped up. Let's see, next one. What would now be on your buy watch list, short list of quality with strong balance sheet, strong sector prospects, quality earnings? You know, I'm wanting to look at good net profit margin at the moment. So I created this specifically in a folder called ASA for you guys, just to show you. This is the sort of thing I'm looking at the moment. Find me stocks with net profit margins growing. Find me stocks where the sales are growing in a tough environment. Keep it to the ASX 200 only. Run the search. So these would be some of the companies that I would then be taking a closer look at. Now, I certainly wouldn't want to be touching zero at this point based on just how much it's fallen in price. Sure, it does tick a lot of boxes, but it seems awfully volatile at the moment. So, you know, I'd probably not feel too comfortable at this point. But, you know, these would be some of the companies here that I would start investigating further. Now, again, please, this is not financial advice. You need to speak to financial professionals out there. This is just starting to narrow down the search from which I could then investigate further. I'm not saying that that's what I would buy, but that's how I would start narrowing it down. Okay, let's see. Coming through the next one here, Rama asks, how can VectorVest reliably forecast earnings 1 year in advance during a pandemic? It is able to take into account stocks that might be impacted by the current circumstances. Ryan, there's a lot of math that goes in behind it. You'll see that a lot of the companies at the moment that we're providing the analysis. Now, just on that, we've been doing this for over 25 years. Okay, so it's pure math at play. We take what's publicly available, so historic and current, and then we also build in the forecast. Now, where companies come out and give us regular updates, like the big companies, they're much easier to forecast because they're keeping the investor informed. Now, in the current environment, they're not. So you'll see that a lot of the earnings profiles at the moment, we're not able to pull in as much as what we typically can. But you'll see that for a lot of the shares out there in Australia, the earnings profiles are falling, and a lot of them are falling quite heavily. Okay, so I'm confident that what you're seeing on the earnings profiles is very accurate as to what's taking place currently. Okay, but it's not just about what the shares are currently doing on the forecasted earnings. You wouldn't be going into the market until such time that it's the right time to be in the market. So your market timing is more important than your earnings. stay out of a falling market. When the market starts rising, the sun starts to come back out again, and then go and pick on your companies with good quality earnings. Let's see, Hannah asks, I was wondering what makes the Visa jump so high. So again, if you hopped into a company like that, you could do all the analysis on that, and you could start to look, what are the net profit margins, what are the earnings, what are the sales growth rates taking place, what are all those key factors doing at the moment. Okay, so we can see in recent times, yes, it did. Earnings, I can see the earnings went up here, but I can see they're definitely coming off again. So I'm not as convinced. I'm wondering whether it was also a lot of consumer sentiment too. It's kind of like the fear of missing out. Everyone wants to jump in. But I can see over here just roughly doing it. Saw a good uplift in those earnings. So that certainly is one of the drivers. From a technical perspective, it was holding up on technical. So yeah, I'd say a lot of it was driven by fundamentals. It was growing its earnings, so it helped it go up. It was a little bit overvalued at times, not dramatically, but yeah, that was one of the drivers, one of the many drivers. Okay, next one. All right, so a few of you asking, yes, email address. So on that one over there, it's my name, full name, @VectorVest.com. Okay, so I'll just spell it out for those of you that want to drop me an email. It's Russell, RUSSELL, Markham, MARKHAM, @VectorVest.com. Russell Markham @VectorVest.com. Okay, very good webinar. Notes, Don, no problem. Thanks for coming. So, yep. Okay, so a few of you are now giving me some ticker codes. Now, look, I am mindful. I have gone a little bit over. I guess that's the beauty of a webcast. We're not going to get the air conditioner turned off and booted out of a room, but I also want to be respectful to the ASA. I don't want to go too much further. So if it's okay, I'm going to leave it. I'm going to give it about 4 more minutes, 4 or 5, and then I think we best wrap it up. Okay, so what I'll do here is I'm going to go to watch list viewer, and I'll just give you a rough idea as to what it takes now to start perfecting your portfolio. So a few of you have given me a few codes, so I'll plug them in. So CSL, yeah, great one there. AZJ, so I'll plug these in. Macquarie, MQG, and let's see, are there any other here? Yep, BHP, ANZ, and let's see, Wills. Okay, there we go. So I'll put those. There's many more codes. I've just grabbed just a handful. I do apologize if I didn't get your codes. I'll just show you roughly what I'm looking for. So I'll put these into watch list, and then straight away down the bottom, I just want to look at the big picture to begin with. So I come down to the bottom, and all I want to do is I just want to get a snapshot as to what this set of stocks is doing. All right, so I can see, yeah, you guys are onto it, right? It looks pretty good. Look, a great set of earnings in recent times. Had a pullback. But what's interesting is that where a pullback takes place, where there's strong earnings, yep, you got it. The earnings will eventually drive that price up again at some point. You've given me some good stocks here. When I look at I wouldn't say ANZ as we've seen earlier, but the net effect is good, right? I can see net profit margin here, 20%. Great, so making 20 out of every $100. So again, that's a big tick. All right, so some very good stuff here on average. How can we improve it? So what I like to then do is I then like to look for any signs of weakness. And one of the signs of weakness that I like to look at here is something like our ratings at the moment. Buy, hold, sell. So sell ratings means that the share price is under a bit of pressure. So we could potentially alleviate by removing some of the sell-rated stocks before they come back up again. But there's one last one I'll leave you with tonight. Also like to look at the earnings growth rate taking place. What is the 12-month outlook on the earnings growth rate at the moment? CSL 24%, great. BHP, even though it's under pressure at the moment, it's still got an earnings growth rate of 12% currently on the books. This one here, not too bad, 8, and then we start getting a little bit lower. So here the growth rates start to slow down. I think it's fair to say that ANZ is definitely the weaker link of them from an earnings growth rate perspective at -5. So what I do is I'll clean it out. I'll take that one out. I'll say, look, I'll reconsider it when the time's right. I'll remove it. It then recalculates. So I'm looking from a macro perspective as well as a micro perspective. Come back here, I look at it again, I go, okay, looking to pay out at 2.93 dividends across these stocks, 55 safety track record. Great, so good from a dividend perspective, getting about 60% franking credits. Let's have a look at what the profile now looks like. So I want to make sure I've got the good earnings, I've got the good net profit margin, I've checked the dividends. Yeah, it's pretty good. The earnings are doing what I want them to do. The safety, we've seen that dividend safety is at 55, so we know the dividend's pretty good. Net profit margin sitting at around about 20%. And these companies are also looking on average to grow their sales. So not only are you getting a good steady 20% net profit margin, but you're also getting a strong sales growth rate. That's what I like to do. So these are some of the techniques that I use myself when looking to perfect my self-managed super fund portfolio. And again, please speak to a financial professional. This is not to be taken as financial advice. This is just purely for demonstration purposes. Okay, so I think that's just about everybody in terms of questions. Let's see. Great to hear. We will be sent the recording. Could you please also get the slides? Yes, a good point. So I'll get the team there at the ASA. I'll get Christine the slides as well. Let's see, Danny notes, in pension mode and with big losses on paper, how do I recover losses apart from just playing the waiting game? Yeah, exactly. And this coronavirus, you're not the only one, Danny, that's caught a lot of people out. I think my takeaway from this is quality. You want to do this exercise, put all your stocks that you've got, put it into a watch list of some sort, whether it be VectorVest or whoever it is that you want to use, and look at the earnings on those companies. And you might have to make some tough decisions where you say, you know what, some of these earnings are just not stacking up. So for example, if I showed you the earnings on our big banks 4, 5, 6, 7 months ago, most of you would have looked and said, ooh, yeah. If I showed you the earnings on Telstra 2 or 3 years ago, a few of you would have gone, So I guess you have to check those earnings and be prepared to make some tough decisions and make sure that when the market does turn, that you are picking up good quality companies that are growing their earnings. That is my key takeaway when managing my self-managed super fund. I'm not interested now in holding into companies with falling earnings. Okay, so Danny, that's probably about as far as I can go without giving advice. Check out your stocks, check out the earnings, and look at the earnings carefully and consider companies with solid earnings. Okay, the other thing too is use risk and money management rules going forward so you don't get caught out. Now, you may very well have been using risk and money management rules, but a lot of investors don't. They don't use stop losses, they don't have a trading plan, they just buy and hold. And when we get things like the global financial crisis coming through, the pandemic coming through, it can be quite a difficult strategy to hang on to. Okay, well, thanks again. I'm really privileged to be here tonight. Thank you, everybody, for coming along. Hope you got a lot out of it. And yes, we will get you the recording. This has successfully recorded. Okay, so that's great. It's all worked out. I'll just put my email address in here. I think did I put it in? There we are. Yes, there it is. So there's my email address. I did mention it before, but there it is, a little bit easier to see. So russellmarkham@vectorvest.com. Please feel free to give me a bell or an email, and I'm happy to call you too if you want to chat to me. Okay, so thanks. Hope you got a lot out of it. I'll get the team at the ASA the recording. So what I do here at this point is I then encode the video and I put it onto the server, and then I share the link with the team, and the team will then get you an email out saying thanks for coming along, and here's the link, and you can then watch the recording. All right, thanks again. Have a great evening, everybody. Thanks for your time tonight. Bye for now.